Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Stocks bounce. So after a rocky start to 2022 here, stocks have staged quite a comeback in the past week. The rebound began with a strong rally last Friday that continued this past week as investors unwound bearish bets and dip buyers came into the fray. Strong earnings from Google parent company Alphabet added to the shift in sentiment as investors are hoping that underlying fundamentals remain solid for America's largest companies. Now, while we would agree that earnings fundamentals remain strong, there are some cracks in the facade. For one, overall earnings growth is in fact decelerating quite rapidly. And even though the majority of companies are beating expectations, it's a smaller majority than last quarter, and the average magnitude of earnings beats is less than it was in previous quarters. Now, there have been several significant downside surprises and weaker forward outlooks from the likes of PayPal and Netflix. Both of those stocks dropped in excess of 20% after disappointing earnings reports. Now overall, not much has changed. The Fed is still on a path toward tighter monetary policy, even as the economy appears to be decelerating. Despite the recent rebound, I'd expect a few more bumps in the road for markets in the coming weeks. For this week's featured insight, fade investor sentiment. Now, the past few weeks have shown investor sentiment to be a rather powerful market timing tool, and while we don't advocate trying to time the market, you can certainly use sentiment indicators to avoid making bad decisions. Most investors tend to buy when they feel good and things seem positive, and they tend to sell when they feel bad and things seem negative. This is a natural force of human emotions. However, the reality is they really should be doing the exact opposite, or at least they should try to avoid doing what everyone else is doing at the extremes of market sentiment. Investors headed into this year with a lot of optimism. Flows into mutual funds were strong, and investor surveys showed little worry about market downside. Now, rarely is that a good time to take your pile of cash and go all in on stocks. In the first 3 weeks of January, the S&P 500 index proceeded to fall roughly 10% in value. Now, sentiment was at the opposite extreme last week, with bearishness at levels not seen since the COVID-induced plunge back in March of 2020. That is likely not the time you want to be selling. And lo and behold, right on cue, markets have now bounced more than 5% from their lows this past week. Looking ahead, more earnings, inflation data, and sentiment. So earnings season will continue in full swing next week with the likes of Under Armour, Disney, Pepsi, and CVS, just to name a few of the companies set to report their numbers for fourth quarter of 2021. Now, as always, the outlook for future earnings guidance will be far more important than the backward-looking numbers reported. Future expectations need to start rising more aggressively here in order for a durable rally in stock prices to continue. Inflation numbers for the month of January will also be reported next week. Another reading above 7% is expected, and that should keep the Fed talking about planned interest rate increases as the year progresses. Now, that aforementioned inflation has been keeping consumer sentiment rather weak, and it'll be interesting to see if sentiment has weakened further based on now the stock market weakness that's been experienced so far in January when the numbers are reported next week here. We'll just have to wait and see if that's the case or not. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.